You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
The commodity supercycle to me is happening in Bitcoin. The world is going digital. I've been on live TV. One of the anchors said, "Well, Mike, you're a Bitcoin bull," and I like to kind of, no, I'm just been right. And so far.
Thank you for tuning in to Mining Stock Education. I'm your host, Bill Powers, and in today's show, you'll be hearing from Bloomberg commodity strategist Mike McGlone. And Mike, welcome to the show. You cover commodities. You've been at this for many decades, so you know all things there is in terms of commodity investing and analyzing the markets. And I wanted to begin by getting your take on whether we're going to see a commodity super cycle or not. I've been reading several articles over the last 6 months. There are the pros and many in the mining industry that believes we are facing a commodity super cycle, a once in a lifetime opportunity, some have said. But then there are others that say the jury is still out. What would be your take on this?
Good luck with that one. It's like when everybody agrees on something, you know that's a problem. But I enjoy, thanks for having me, Bill. Enjoy getting to know you a little bit. I started in the business at the Chicago Board of Trade. Being a South Sider, we went to the Board of Trade. North Siders went to the Merc. But I like to say good luck with that. Let's first start with the prerequisites. I think was bottom line, the answer, I think, is we might have potential for that in metals. Number one, they're easiest to store, easiest to invest in. But I view metals now, most notably gold, as somewhat naked, if not including this new digital metal called Bitcoin. And the reason I say that is because we have a major paradigm shift going on in this world economy, and that is towards decarbonization, green energy, electrification, and digitalization. And the supply-demand balance for fossil fuels, for crude oil, was bad before COVID, and it's worse now, i.e. Elasticity of supply is just off the charts. I mean, we have, in this country now, we just dropped to near the lowest level of cost of production in our database of $39 a barrel, and crude oil popped up to near 66. So you know what's happening. There's been plenty of producer hedging, so massive supply coming on in fossil fuels. And demand's just not going to be there the way it used to be. They're being replaced by technology, which means demand for metals. So I look at that's the key problem is you need for the old guard commodity supercycle, you need the world's most significant commodity, crude oil, to rally, and that's unlikely. You need a weak dollar, and that's unlikely, partly because the key drivers of the dollar the last decade that kept the dollar strong are still in place, i.e. U.S. yields are relatively higher than the rest of the world, and the U.S. stock market's relatively stronger than the rest of the world. So I view the market more in a significant deflationary spiral being offset by central bank easing, and a lot of that's because of innovation.
Even if we don't see oil driving a commodity super cycle, could we see copper, new metals step up, nickel, these electrical vehicle revolution battery metals?
Well, that's where you have to go for this super cycle. Let's look back and forward. Back to the last 10, 20 years, metals have way outperformed energy. And most notable in terms of total returns, if you're an indexer, and in spot returns. And looking forward, where should we see the demand? So I look at, in fact, I'll be publishing my commodity outlook for April, and I see pretty good resistance in crude oil bumping up near 70, more likely to go near 50 in WTI. And copper, let's use, the LME measure near $9,000 a ton, just got to the highest level in 10 years, and it's near the upper end of the range. And I see demand for that, but the correlation between copper and crude oil is still very high. On a 20-month basis, it's about 0.8 on a 1-to-1 scale, so it's very high. Yet we're seeing a breakout higher in industrial metals. I see that. I just near the upper end of the range. I want to be the first buyer. I fully expect to see a decent support in copper near $8,000 a ton. But I'm really kind of finding a little dicey at these levels to be a first buyer. But I do think bigger picture, looking forward next 2, 3, maybe 10 years, is metals have much greater appreciation. And it's just the one thing you mentioned, nickel. I am a macro commodity strategist. I really focus on the macro. We have a metals team, most notably based in London, and they point out to me that nickel supply is very easy to bring on, and it's still way oversupplied. I think the peak in nickel was around $40,000 a ton, and here we are at 16. So yeah, energy, electricity, metal, sure, which means silver.
hmm Your near-term outlook for copper, then, it's not going to bust through the highs we've seen recently. Is that fair to say?
I look at convergence a greater risk. And so I'm near term, just don't want to be the first buyer. And when it finally broke above 7,000, I looked at it as pretty good, but now at 9,000 and backing away from, I think it peaked around 9,300, which was around the high. The high was around 10,000 from 2011-12. But near term, no, you want to be very careful here, particularly if we see a continued reversion towards $50 a barrel in crude oil, because there's that high correlation. There's that drag from crude oil. They're the two significant macroeconomic commodities, but they have been diverging in terms of performance. Copper's been doing better. Crude oil, bigger picture, just can't get above those. Remember, the high in crude oil was 145, and here we are at 60. But the key thing I want to bring in as we transition is when you think commodity super cycles and overall commodities, look to natural gas. It's the most U.S. natural gas, the benchmark that trades on the CME, is the world's benchmark significant measure of electricity production and heat, and it's still down 90% from the highs. It's running 2.5, 2.4 or so MMBTUs, and the peak was around 15. And we're just, the whole world, there's massive demand for it, yet there's just so much supply in the back of innovation.
So then, obviously, you're projecting less demand for oil and gas over the next decade, and I would assume that when you look at that and you conclude that, you're analyzing the political situation in the world, aren't you, when you come to that conclusion? Because you're looking at policies that's going to drive that.
Oh, political and economic and natural. There is a major shift towards EVs, and it's accelerating. And I had the honor of interviewing Kathy Wood recently on we had a Bloomberg Crypto Summit. And her quote was, the average EV cost in this country will drop to $18,000 per vehicle in about 5 years. Now, I bought an EV 6 years ago. I bought a Volt and I paid 36 with subsidies. I got it for 29, but that's just normal progression, declining costs of most notably the batteries. It's just, unless you expect that to reverse, that's a trend that's accelerating. And then for those of us who've been to China and know, and we all don't have to go there to understand, you can't breathe. There's a major trend towards, the people used to say, oh, they're, get everybody in China to get an automobile. They're not. They're getting EVs, and they're getting them cheap, and they're becoming cheaper and cheaper. Yes, they do use some coal to produce electricity. That's another whole story. But that's a key trend that's accelerating. And then so that's both sides. Demand for transportation vehicles is declining. In addition, we have this major shift towards more flexible work schedules, most notably in this country. People just aren't driving. You can see in the background of my office there's no one here. Like, this is in my section, there's 100 people. They're just not coming back. It's shocking. And they're just getting up from their bed, going to the office and walking back to the bed. It's 15 steps. They're not driving in a car 50 miles or taking a subway or train or anything. So that's a shift globally that's really changed. So the key thing I want to end in is incremental demand. Demand for liquid fuels in this country is about the same as it was 20 years ago, around 20 million barrels a day. 20 years ago, that's basically unheard of economically. It's most notably because of more efficiency, not really EVs. Yet total supply of liquid fuels in this country and GDP have both increased about 100% over that 20-year period.
Where do you stand on the inflation, deflation, stagflation debate?
I think when we write the textbooks about this period in history, the market's going to look at it as one of the most significant deflationary periods in history. And that's part of where, as much as our listeners and viewers might poo-poo central banks, they're just reacting to what I see as significant deflationary trends on the back of innovation. So here's one example. I live in Connecticut, and when I take the train, I take an airplane, I cross the Whitestone Bridge. And 2 years ago, there was maybe an average of 100 people manning those toll booths. Poof, now it's zero. They're gone. I used to work at Chicago Board of Trade. Poof, it's gone. I used to be a voice broker. Poof, they're gone. I mean, this is just happening rapidly. Now, in terms of commodities, more and more supply of liquid fuels. I used to own a farm, and a lot of that corn is used for ethanol. That's becoming more and more efficient. More and more technology pressuring prices for things like that, and reducing demand. Most notably, we're shifting. The demand for fossil fuels is being replaced by technology and metals. So I view it as deflationary, central banks catching up. And I think that's the key thing I want to leave with is I think the headline for my month's outlook for commodities is bullish commodities, broad commodities, and inflation is bearish innovation. People are missing that fact about what's happening in the society, i.e., I mentioned the average cost of production for U.S. crude oil has dropped to $39 a barrel. And on the screens right now, I see about $60, $61.
How would you explain it to just the average Joe citizen that says, Mike, my grocery bill is going up. Even when I buy lumber to do a little project around the house, it seems like it's twice as what it was 5 years ago. What would be your answer there?
Lumber is a key, I would say, outlier, and it's a good point, Bill. Lumber's near all-time highs, most notably because there's a significant building boom. And why are we having this building boom? Because people are shifting from the cities to the suburbs, and they're not driving as much. So it boosts and busts. By the way, lumber is a great indicator, but it's very insignificant in terms of it's not in any of the broad indices. It's not widely traded in futures. On a scale 1 to 10 versus crude oil, it's basically a 1 in significance, and crude oil is a 10. But you need to buy a house, you need the lumber. That makes sense. I get that. The more significant inflation is really in financial assets, which you would expect in a world that is really based on negative rates, massive fiscal stimulus, and very low interest rates, and quantitative easing. Now, why are we doing that? Because we have to, because things are declining. Why? And if we didn't do that, where would prices be? They'd be plunging. So we're seeing price advances, and most notably in financial assets. And I think what I see happening going forward is financial assets, particularly stock markets, getting very expensive. Total market cap to GDP is very high, the highest ever, basically. Yet housing and residential homes are just catching up. They're still quite low relative to GDP. So I see that shift's coming. And of course, we have the lowest interest rates in the history of mankind are kind of helping.
Mm-hmm. Mike, I've heard you talk and give very bullish numbers on Bitcoin. Would that be the thing you're most bullish on right now?
So yeah, Greg, Bill, I'm glad you brought that in because I forgot to mention that the commodity super cycle to me is happening in Bitcoin. The world is going digital. I've been on live TV. One of the anchors said, "Well, Mike, you're a Bitcoin bull," and I like to kind of, no, I'm just been right, and so far. And what I see happening there is, first, let's start with the problem it solves. Never in the history of mankind have humans been able to store, transact, transmit, and transport a store of value that trades 24/7 easily and on like a thumb drive. That's not happening. We've had gold, but it's difficult to transport, transact, and you still got to verify it. This is happening, and it's happened organically. It's not something that it's the liability or the project of a government or an entity like gold. It's an organic. It's not liability. It's not a currency. So, as much as people want to poo-poo it, the fact that the world's largest automaker by market cap, Tesla, is starting to allocate part of its equity wealth to Bitcoin. To me, that's part of the paradigm shift that just kicked in about a month ago in the world. And it's just a falling domino situation right now. So I'll end on this: is any investor on the planet who has 100 units of any type of assets, most notably gold, but any types of 100 units, knows now that if they don't allocate at least 1 or 2 of those units to Bitcoin, they're at greater risk of this digital global reserve asset just continuing to do what it's been doing, becoming the world's benchmark digital global reserve asset, and it could fail. But if they don't allocate, who cares about 1 and 2% of portfolio? But if it continues to do what it's doing, which is well on the pace and it's got plenty of upside, then they won't get fired. And if they don't, they could be fired.
So in 10 years, does Bitcoin make gold obsolete? What's gold's role in the future of the economy?
So that's the key thing. The fact is, right now, the pace of flows out of gold ETFs and into Bitcoin funds is clearly indicating that gold is becoming redundant. Now, it's a question of duration. So I clearly see those trends accelerating. And the way I look at it is now, I think every entity on the planet realizes, like I mentioned earlier, if you don't allocate some of that gold wealth to Bitcoin, you're at greater risk. That should continue. And what has to happen is something has to trip up this Bitcoin trend, which I don't anticipate and I don't expect. Or the way I look at it is holding gold without having some Bitcoin in that same bucket is basically naked. appears as naked. I think that's the key thing that really kicked in Q4 last year. Is now gold's down 9% or so in the year. Bitcoin's up almost 100%. I don't see what's going to stop that trend. I'm not bearish gold, but I'm no longer bullish like I was when it went from 1,000 to 2,000 and didn't catch the bottom, didn't catch the top. But I just can't see the upside right now because one key support for gold is gone at the moment. That was investors. Exchange traded fund inflows have switched to outflows significantly, and I think it's because everybody sees that yes, I have maybe too much gold and too little Bitcoin if the trends just continue.
So do you think it's not just futurists that are moving into Bitcoin, but it's actually the fear trade, people that are trying to preserve wealth that are moving into Bitcoin right now?
Well, at the moment, it's not a think, it's a fact. Let's look at Tesla, let's look at MicroStrategy, and of course, a lot of billionaires and hedge funds, Paul Tudor Jones, you name it, you name it on the list. Now, I think what's happening is the naysayers are dropping like flies because they realize they're kind of starting to look like people who rejected the internet when it first came out, or electricity when it first started proliferating in New York City initially. So I think that's one of those key things I think is most important about what I do is not so much analyzing markets and trends and trying to interpret markets, but it's human nature. And that's where I figure the most prudent investors on the planet are all to understand that if they don't allocate some to this space of Bitcoin, they're at greater risk. So to me, that's what's happening. And at least more recent, I heard of sovereign wealth funds. And I think it's inevitable that central banks will have to buy it, partly because they're some of the biggest buyers and holders of gold. And I've held some of these bars down at the Federal Reserve Bank and got to see the gold down there. And it's biggest stash on the planet, not just for the U.S., but held for other central banks. And there is a sense that's becoming somewhat redundant. There is a risk that we might look back at this period from 10 or 100 years from now, and like that, that there was a Twilight Zone episode I remember I loved from the 60s that predicted 50 years ahead gold would become worthless.
Oh, wow. Interesting. I haven't seen that one. Last question. Suez Canal, it's blocked right now with that big container ship. What's the significance of that from a macroeconomic and commodities perspective?
Very little. Let's start with crude oil. Very little. It's most notably a blip in the trend. It might spike prices in the short term, but the bottom line we have to ask ourselves is it increasing demand or reducing supply in the big picture? No, in fact, it's doing the opposite. So what it's actually doing is similar to the spike in prices we had when Saudi oil assets were attacked in 2019, and the spike we just had recently when we had a deep freeze in Texas. It's allowing producers to hedge forward in futures, and that's showing up. Commercial hedging in crude oil is reached almost the highest level from 2018. And as you're commercial, you don't hedge, you don't sell short unless you got supply coming on, unless you expect it. So right now, it's just what OPEC has done to themselves. They created an artificial high price, which with normal economics is allowing regular producers with advancing technology to produce at a greater level. And that's why I like to rope in thank you in the short term. I'm sorry, and it's discombobulating in the short term, but it only makes it worse for those existing trends, and that's the key bottom line for crude oil is too much elasticity of supply and slack demand that's only accelerating. Mike, for listeners that want to stay abreast of your work, where would they find you? I'm on the LinkedIn, happy to LinkedIn with people, and I interact most on there. I am on Twitter. But I just don't react too much. I post my stuff, and I have some followers, but I just don't have time to really. Mostly LinkedIn. So happy to, and if someone wants to be on our list, they can just link in with me, and I can put them on my distribution list. Mike, appreciate you coming on the show. Thanks for joining me today. Bill, thanks for having me, and looking forward to speaking with you again.